Hello traders, this is Julian. I'm the other half of Darkside. You have been actually used to Jonathan voice on our YouTube channel, and it was kind of solution for us with him being a native English speaker, and we thought it would be comfortable for you guys to watch his videos. But since we believe that the message delivered is more important than anything else, is more important than the language barriers, you'll start getting also videos from me on our channel in the future. Now, as my first video, I wanted to talk about liquidity. We at Darkside have always seen liquidity very related to the algorithm, and on the other side have considered the algorithm very related to the action of the traders and actors in the market. That means that the liquidity is always changing and it's not static equal highs, equal lows, or in the form of trend line, like vast majority of the traders have considered during the last 2 years. The idea to talk about liquidity was inspired by the NZD CAD trade that we shared on Telegram, and how the algorithm didn't have to deliver to the order block traders, didn't have to sweep the trend line liquidity, and not deliver a perfect break of structure as smart money strategy were expecting there, and maybe it's a readjustment of the algo according to one strategy in order to not let those guys, the order block sellers, to take the ride along with the algorithm to the downside. And this is just a simple example of how the algorithm readjusts according to some of the strategies used, and how we should never consider trading as a static and schematic way, but as flexible. The same way liquidity is flexible and adjustable according to how the algorithm behaves. Because if we consider trading as static and we see things as static and schematics, the same way we'll see liquidity and we'll not be able to notice when it's time for liquidity to change, and we'll be stuck in the usual equal highs, equal lows and trend line liquidity. That said, if you really think about what's behind the market algorithm and feeding the liquidity, it's the entire actions that we take as traders, the buying orders, the selling orders, which, by the way, if you think deeper, we make a mistake just to consider that as a trade taken, because what we do when we open a trade, a buying order for example, we sign, let's call it this way, a contract with the algorithm that we are buying at a certain level, and if the price goes against our direction, we have to sell back the product to the algorithm with a lower price and keep the difference in a form of loss for ourselves. And if things go well, and the price goes to the intended direction, the take profit means that we are selling back the product to the algorithm at a higher price and keep the difference as a profit, of course. And the same applies to the selling trades, the same idea, but what's common for all of them, for all these levels, is the fact that there is product exchanging on those levels, there is interaction, and those are areas recognized by the algorithm as hot areas in the market, or else different liquidity levels in the market. Now, as we all know by experience, the algorithm tends and loves to visit the area of stop loss, of course, more than the take profit areas, because it's the idea of the casino behind it, where the dealer and the house majority of the times win. But of course, there should be times when the house let the gamblers win. And since we are not gamblers, we must read the algo behavior. Now, if we go a few years back, probably 2018 or 19, when smart money used to work and smart money just started, and if you really think deeper, smart money was just the baby of the algorithm changing behavior because of the trendline traders' liquidity. Because the fact that the price used to react at this level, at the order block, happened because there were actually trendline traders engaging at this level here. Now, if we think about these trendline sellers here, and what they did was exchanging product in two levels, the entry point and also at the stop loss. So the algorithm took the product back at the stop loss and started looking for other actors in the market, which in this case were the order block sellers, and delivered the product to them. And that's why smart money used to work back then, because they were the child of the trendline sellers and buyers. And imagine if there is no one selling and engaging and trendlines anymore, what will that do to the algorithm and to the liquidity? So since there is not a lot of people engaging on the trend line, there is shortage of product. There aren't a lot of them like transporting the product for free from the trend line till the order block. And that's why nowadays, with the new market conditions, the smart money concepts and the smart money schematics are static and cannot read liquidity properly. So yeah, this is just a simple example of how we see the market with the eyes of the algorithm, rather than talking about banks trading and banks levels, like trading with banks, sniper entries like banks. What about now? Did the banks change the way they trade? Or is it just the algo that shifted the behavior and readjusted the behavior? For us, it's more possible the second one. So, by this simple example of understanding the algorithm and liquidity from the trend lines, we should be able to see different levels of liquidity, such as Darkside does, deriving from different strategies, deriving from the main used type of trading at a certain period of time. Of course, being able to spot these different levels and types of liquidity, it's up to you guys, it's up to your work into backtesting. That said, I want to emphasize a fact that the cycle liquidity is a concept of Darkside and only of Darkside, and it's been used by us for a few years now. But yeah, it's all good. We'll be first for a few things in the future. Yeah. Now, focusing on the same idea of the trendline liquidity, this is an example of the same pair, but a few years back when smart money used to work, because there were actual traders engaging and creating the product on the trend line and transporting the product for free towards that order block. And that's why the idea and the connection of the buyers and sellers used to work. But we all know that nowadays is just a minority trading those trend lines, which raises a big question mark of how the algorithm will approach that change. That said, we can clearly agree, I guess, that this is the algo behavior and readjustment, but the smart money mentors took this flexible readjustment of the algo and turned it in a static schematic way of trading, which is not right, and came up with different ideas such as order block, and gave them some stupid explanation, such as the bullish candle to the upside before the movement to the downside, and explained that it had to pull back because the banks firstly bought to put everyone in the wrong direction, and the price has to come back to that level in order to release those banks from the loss, of the initial position. Now, come on, it's so stupid to actually say that, but it's more stupid to believe that. Now, how can the bank do that, and why should the banks do that? And adding to that, they also added the fractional market idea. So if the price churns on 1 minute or 5 minutes, it should churn on 1 hour or 4 hours on daily. Now, I'm sure that you have noticed by yourself, but we can show you hundreds of examples that the fractional market isn't the way they describe it, and majority of the times is creation of liquidity. And to consider that there were mentors out there which sold this bullshit for like 5k because they were trading with the banks, and now out of nowhere they are not trading anymore with the banks, but they are recognizing the algorithm. What about the banks? What about the banks now? How can you sleep that you took like a lot of money from the traders? Not even that, but you also added like an inducement thing, a weak leg in between, and you sold that for 10k. You sold fake dreams. You didn't sell a proper trading career, because you know what you did. You uh, you made trader believe that it's possible to build a career upon 1 to 3 pips stop loss. You made trader believe that it is possible to build a trading career on 1 to 1000 RR. And another thing that you did is, by giving these ideas out there, you made the prop firms bloom, because they thought it was normal to set unrealistic targets such as 100% or even 200% a month return, because at the very start it was 100 and 200% return. Because if you think about it, they gave you on a 100k account, they gave you like 10k tradable balance, and you had to make 20k on the first stage, and then 10k on the second stage, which is 200 return and 100 return. All of that because of the fake expectations sold to a lot of traders. And that's how, same as these mentors, also the prop firms ripped traders off same way as you did, and made tons of money. But a suggestion: before trying to copy anything else and see other trader strategies and add those strategies to your style, try and backtest the market by yourself and see how hard that is and how much work it requires. And then it won't be that easy for you to steal others' work. And yeah, that makes me mad, guys. I'm gonna light up a cigarette now. That's all I wanted to share about liquidity and the idea of Darkside versus liquidity. All love to all of you, except of course the smart money mentors. To all of you, fuck you rats. Hello traders,